You're welcome back, guys. Now let's look at recognition of share-based payment transactions. The goods or services acquired in a share-based payment transaction should be recognized as either an expense or an increase in assets when they are received. And if the goods or services were received or acquired in an equity-settled share-based payment transaction, the entity should also recognize a corresponding increase in equity, okay, that would be probably placed in a reserve. So the double entry is debit asset or expense, depending on the goods or service, and you credit equity in an equity-settled share-based payment. But note that IFRS 2 does not specify where in equity this credit entry should be recognized. This is a very complex area, and what entities should do is to take legal advice to comply with local legislation. The credit entry to equity usually will be presented in the statement of changes in equity. It will not be presented in the statement of other comprehensive income because it reflects the issue of an equity instrument and it is not an unrealized gain. Okay? And if the goods or services were received or acquired in a share-based payment transaction, then the entity should recognize a corresponding liability. And this is because a cash-settled share-based payment gives rise to an obligation to transfer economic benefit in form of cash. Okay? So the entity would debit expense or assets and credit liability. Recognition of share-based payment is the aspect of IFRS 2 that has caused controversy. Okay? And this is mainly in relation to employee share and share options plans. Many respondents to the exposure draft and the discussion paper before IFRS 2 was eventually issued agreed that it was wrong to recognize an expense in respect of an employee share plans. Okay? And they raised a number of conceptual and practical concerns, including the fact that there is no cost to the entity and that the expense cannot be reliably measured, which is right. Okay? The entity is just issuing shares in return for service. Okay? So the entity is not incurring any cost. They are just issuing their existing shares. That was their stand then. However, the final decision was that the rationale for recognizing all types of equity settled share-based payment transaction in equity, okay, whether the equity instrument is shares, share option to employee, suppliers, or whoever it is, okay, is that the entity has engaged in a transaction. Okay, and that transaction is essentially the same as any other issue of equity instrument. So it's just like the entity is issuing a fresh shares to the public. Okay, so in other words, the entity has received resources, that is goods or services, as consideration for the equity instrument. So it should account for the inflow of resources in form of goods or services and also increase the equity. Let's clarify transactions in which services are received. Okay? Because that seems to be a bit confusing. We'll look at that in the next video. See you guys.